I have been a professional foreign exchange and futures trader dating back to 1975 at the Chicago Board of Trade. I am a classical chartist. I've used price charts to earn my living during all of these years, and in the process have learned a lot of lessons, some the hard way. And it's really those lessons and that perspective of all of these years trading that I'd like to bring to you. I'm Peter Brandt. I am a classical chartist.
Peter, brilliant to finally sit down with you. You came into my world only about a year or so ago. We got introduced and somebody said, you need to sit down to speak to, in fact, it was Mark Ritchie's son.
Yes.
Who said, you've got to speak to Peter Brandt. He's a really interesting guy. I said, sure, I'd love to. And then sat down with you and started talking and realised the immense wealth of experience you've got and the incredible track record that you built up over the last almost 5 decades of trading. And nobody really knew who you are. You have a publication called Factor, which is an advisory service. I just think it's a fantastic opportunity to sit down and really learn from a legend that amongst the people who know you, everybody says you're one of the best traders they've ever come across.
Well, they're overstating that, I'm sure, but it's great to be here. And we got connected. It ended up we started talking, and we had connections all over the place, right?
That's right.
I mean, you knew this person, I knew that person, you had done this, I was familiar with that, and it ended up that we had multiple contact points, which was just great.
On RealVision, people have been kind of blown away. You came out of nowhere, suddenly started producing the charts using classical charting techniques and with your set of rules, and everyone was like, wow, is this for real? Where does this guy come from? Because you don't kind of get this. There's a lot of kind of fly-by-night snake oil salesmen who are around, and people, you're on Twitter as well, which people would never have expected, that here's somebody who has no real reason to be on Twitter, and there you are, publishing kind of stuff, helping out people who are just trying to get into this world and understand the world. I think it's amazing.
Well, Twitter is just such a crazy world. And, I lived most of my trading life pretty much behind the scenes. People didn't really know me. That's the way I wanted it. I wasn't a hedge fund trader. I traded for myself for the most part. And then John Wiley had talked me into writing a book in 2010, 2011. And then they suggested that I get a Twitter account, of course, as part of the promotion to sell their book. And I became engaged in this crazy world called Twitter, and my life hasn't been the same since.
No, you've got tens of thousands of followers now.
Yeah, I think between Twitter and StockTwits, I have like 110,000 followers, and I kind of go, who are these people? It's crazy.
So I think the best thing is let's start at the beginning. How did you get into this business? And let's kind of talk through your career, and let's pick up some learnings en route, and let's take people through the journey, because I think it's such a brilliant journey.
Well, it's been a crazy ride at first place. I graduated from the University of Minnesota. I had a major in advertising, of all things, journalism.
Right.
And we moved to Chicago to work at an advertising agency, one of the biggest advertising agencies in the world. I think at the time it was number 7 or 8 in the world. And I worked on some fabulous accounts as a young guy. And here I am. I hadn't even turned 25 yet, and I'm in Chicago, and I'm working on McDonald's and Campbell Soup Company and some wonderful companies. And we lived in Evanston, Illinois at the time, and met a guy in Evanston, Illinois, who was a soybean trader. He said, Peter, come down and see what I do. Come down to the Board of Trade, and we'll have lunch overlooking the wheat pit. And all the exchanges at the board were on the 4th floor then, and so we were in the members' luncheon room on the 5th floor, and I just became, you talk about a hook in the mouth incident with big barbs, right? And I was just hooked on this idea. And the more I found out about it, these guys are yelling and screaming and fist fights breaking out. But yet at the end of the day, they go home and they know to a penny what they did during the day. They can measure the performance, their own performance. They're not sitting in meetings. They're not writing memos. They're not a yes man to a client. They're on their own. And it was wonderful at the Board of Trade because the grain markets opened at 9 o'clock, 9:30. They were done at 1:15. How cool a day is that?
Yeah, and it's so different to the world of advertising, which is almost nothing is measurable.
Nothing.
And suddenly you've been introduced to this world where these guys, as you say, they know exactly how much money they can take home every day. So how old were you at this point?
I think I'd 26, 27, right in there. Just past the 25. I wasn't approaching 30. But it was a question then, how do you get in the business? Because back then, and the commodity world as we know it was really only like 2 years old at the time. We had the Russian wheat failure. We had...
Which year was this?
This was 72, 73, really was the start of the modern markets that we know them.
Yeah.
I mean, the IMM had just introduced currency markets, I think, in 74. So that's, I'm right there on top of that. The first interest rate market was introduced, Ginnie Mae's, which was a mortgage instrument at the Board of Trade. This was before T-bonds.
Wow.
Before T-bills even. And there was not any MBA fast track. I mean, you don't go and say, I got my MBA from Brown, or Harvard. Welcome.
They didn't care in the pit.
Yeah, I mean, you run paper, you start from the beginning, and everybody starts at the bottom. And I was able to land at least a job that I think at the time might have paid me 50 or 60%.
How did you get that job? So you're in advertising.
I knew a guy.
Pit.
Knew a guy.
Okay.
I knew a guy that was connected with Continental Grain Company.
Okay.
And Continental Grain was, at the time, the second largest grain merchandiser in the world, next to Cargill.
Yeah.
They traded everything. They were major. They're out of the grain business now, but they're a capital management firm. And so it was starting at the bottom. It was learning what a futures contract is. It was... and I remember going home and telling Mona, hey, I'm going to do this. The good news is I'm only making 50 or 60% of what I was making, and we were slim for money as it was.
So you'd already done the best trade of your life, married Mona at this point.
Yeah, for putting up for a trader for so many years, you bet. I mean, we're going to be married for 50 years in 2 more years, so that's a long time.
So you did your best trade early on. And
I did my best, and it went downhill from there. But it was just a crazy deal, and so they're going, so how are you going to bring revenue in? I mean, what are you going to do to bring revenue in? What are you going to do so that we'll give you access to the floor? You're going to have to prove yourself. And it was lucky that my customers in advertising was Campbell Soup and McDonald's, because I went to the president of Campbell's and I said, there's something, this futures market, you guys just got hit like crazy by runaway soybean oil, runaway commodity prices, and at the time they owned Oral Wheat Bread, Pepperidge Farm, Godiva Chocolate. They were growing 130, 140 million chickens a year in 2 locations in the U.S. And so they were commodity sensitive, and those commodity companies, those producers, could not raise the price to their consumers as they were incurring increases in prices. And so the idea of hedging was at the time like a year old or a 2-year-old thing. The IRS had not even weighed in on how hedge transactions were going to be taxed.
Huh.
And
so none of these corporates were taxing at this. Were
very
at this
few,
point.
Very few. I eventually had Homestake Mining as a customer. They had never hedged. And so I basically said, send a senior purchasing guy to Chicago, have them learn the business, have them stay out here. I remember the hotel they checked into. We'll come back to you in 2, 3, 4 months, and we'll make a recommendation to your management team. And it may be that there's nothing in the market for you to hedge, and it may be you really need to be an active hedger, and it was you are going to be an active hedger. And that allowed me to have an income flow for the first 4 years until I learned the business.
So you did this off your own back. You just thought, I'm going to approach Campbell and tell them what they need to do.
Absolutely. Yeah.
So this meant you were a broker originally, I guess.
Yeah. I was clearing paper while I was learning the markets, and I'd accumulate a grub stake of $5,000, $6,000, $7,000, $8,000, $9,000, and I'd start trading and I'd lose it. And I'd listen to Continental Grain.
That's quite a lot of money back then, right?
It was a lot of. We were trading copper in the 50 cents range. We were trading bonds under 60.
What was your salary at the advertising agency at that point?
I think it might have been close to $30,000, which was a lot of money back in the mid-70s.
Yeah.
And I think that I had a draw. I think Continental actually gave me a draw of somewhere around $14,000 or $15,000. And so, but that's, everybody started at the bottom. And so I was a customer's man until 1980, when I said bye-bye Continental Grain, and I started factor trading as a prop firm at the Board of Trade.
So talk me through, just going back a little bit, losing money the first few times, because it's one of the most important things, isn't it?
Yeah. Oh, yeah, it is.
So your first ever trade, talk me through it.
Oh, I think it was soybeans, and it was a friend of mine who I knew in Evanston, and I said, John, what do you think of the soybean market? And he said, man, I am so bullish. I am so bullish beans. And I think beans at the time were trading like $5 or $5.10. And so I bought a contract of beans and didn't see them for 3-4 days, and I know beans went from like $5.10 up to $5.20, and then they tanked. And they went down to like $4.90, and I bailed out with a 20-cent loss in a period of 3, 4, 5 days. And I saw him again, and I say, so John, so beans. He goes, wasn't it a fabulous move? And it ends up, you know, he's a pit trader. He's trading for 0.5 cent to a penny. And this was a case where he was super bullish and thought maybe there was a 2-3 cent move coming. But I didn't know that. And so great questions. What's your time frame, and what's a big move to you, and where are you wrong? And so I learned about time horizon. And that taught me a lot. And I learned that the terms bullish and bearish mean absolutely nothing, because you have to attach to that where you're going to get in, where you're going to get out when you're wrong, what are you looking for, what's going to change your mind, how you can control your risk, how you can do sizing, and all those things, of course, came over time. And those were all hard-earned lessons, because at this point I was still experimenting. I had tried everything, and nothing seemed to work. I think I burned out probably 2, 3, 4 counts in the meanwhile. And, you know, it wasn't a fabulous size of money, but, you know, back then it was a meaningful amount of money.
So at that same, just thinking about that, is Paul Tudor Jones once gave me a lesson. He said, Raoul, the best traders are the people whose idea horizon matches their trade horizon.
Yes.
So that guy was looking for a 4-tick move, he trades accordingly. There's a lot of people who look for, you know, a huge move in a currency that goes on over a period of a year, yet their trading time horizon is a day. Mm-hmm. That doesn't match.
Well, it doesn't, and that's why when you hear somebody say, well, I'm a chartist, you know, it really doesn't mean much. I mean, what does that mean that they're a chartist? Are they trading tick charts, 1-minute charts, 1-hour charts? Are they trading monthly charts? Are they trading close-only charts? What kind of charts are they trading? And of course, for me at that point in my career, I really wasn't even that exposed to charts. I mean, that came in 1979 when a friend of mine, and I had tried a number of ways to make money, a friend of mine was kind enough to say, I'm going to buy you a book. And I was introduced to the book Technical Analysis of Stock Trends by Edwards and McGee. And that's really the book that changed who I was as a trader. And I just consumed that book, Raoul. I gobbled that book down. So then it was really a question, Raoul, of what that meant personally for me to be a trader. What exactly did that look like for me? What patterns did I like? What markets did I like? What setups did I like? And that's an ongoing process. But I felt that in 79 and 80, I had come far enough. I was now in the business 5 years. And I really think that it takes 5 years to really have a clue for a trader. Some people come in and they expect to be a master of the markets in 1 year and 2 years. Good luck.
Yeah, it's incredibly hard. And it is like, you know, you went 5 years of losing money.
Yeah.
And, as, you know, it's like getting an education. You're paying for a very serious education.
PhD.
Your PhD in markets.
Yeah.
And eventually you get it. And your prize is not necessarily profitability. Somebody gives you technical analysis and goes, okay, this is what you've been looking for.
Yeah, now the work starts, right? I mean, this is where your work starts. And, you know, I was extremely lucky during that period for really 3 reasons. The first reason was I did not need the profits from trading to be able to pay my bills, to go home, to pay my rent bill in Evanston, to buy groceries, to put the kids in Montessori, to buy clothes, because that money was coming through revenue that was flowing to me from Campbell's Soup Company and McDonald's. And so
you could be a broker and a trader at the same time?
Sure, absolutely. There was no prohibition against becoming a prop trader, trading your own account. There was no prohibition. And so all the way along, I knew where I was going. I knew the minute I entered the business, I wanted to be a trader. I wanted to trade my own money for my own account. I did not want to be a broker. I wanted to be a trader. And so it was learning, first off, what the markets were. So I had that cushion. Second thing, when I left advertising, I went to the head of the advertising agency. It was Needham, Harper, and Steers was the agency at the time. I talked to Dick Needham, and I said, Dick, I'm going to go trade grains. I know you think I'm crazy. But if I blow up in a year, can I come back and will you give me the same job for a 25 or 30% increase in salary? And he said yes. So I had the freedom to fly.
So you were obviously a trader at that point already.
I was already a trader. Yeah, I mean, I think back I was a trader when I was, scalping somebody else's, newspaper route and, giving me a penny a paper. Because I'd give them part of my route to deliver. And so that went way back. And I think the third thing is I had a great mentor. I had a guy who was willing to invest his life into me, and it was a guy that was a trader. He had come out of the Cargill system, which is a very specialized, wonderful system. People coming out of the Cargill world are really, really smart. And he was among the best of the Cargill traders. And he became a dear friend of our families. He would come for Thanksgiving. He also loaned us the money to buy our first home. And he really invested a lot in me, and I learned so much from him. Not so much from the standpoint of do you buy beans, do you sell corn, do you buy them here, but risk management. He would just spill risk management all the time to me. He'd talk risk management, risk management, risk management.
And why did he invest in you? I mean, what made him think, I'm going to take this young kid and I'm going to teach him the ways of the world?
I have no idea. I mean, I think he was attracted to my family. He was a single guy. He really had no family of his own. We became kind of his surrogate family, and he latched onto us, and I learned so much from him. It was just the type of thing that you couldn't buy the education he provided, and it was really risk management. It was philosophy. He was a philosopher. He was a philosopher of market speculation, is what he was, and he would spill this stuff. And so I felt comfortable enough that by 1981. I just said bye-bye. I actually gave him the Campbell business and moved over, and he took over that, and I started Factor Research and Trading Incorporated as a proprietary trading firm on the 15th floor of the Chicago Board of Trade. And I guess the rest is history, and at least I think it is.
Well, you're not going to get through it that quickly. So what happened? So 1980, you're now starting on your own.
Yep.
You've now discovered charts.
Yeah.
You've had a mentor that helps you with risk management.
Yeah.
So how's your trading evolved now? What are you kind of doing at this point?
I'm charting. I'm trading weekly charts.
What's weekly charts?
I'm trading daily charts. And, I had settled in at that point with the idea that I was a swing trader, that I would look to take 10% of the underlying value out of a market.
And a swing traders, you're looking for short-term reversals?
Yeah, no, not reversals, because I don't try to pick bottoms or tops. My trading has always been between the 30-yard lines. I trade between the 30-yard lines. I leave the goalpost to the 20 up to other people. And I just want something in the middle. I want a chunk in the middle. And so I just found that charts gave me that ability. And so it was just at the time I was maybe trading 25 to 30 signals a month. I've cut that way back. I'm now, really in the 5 to 8
so
signal
you were never
a month
a pit
range.
trader in the kind of few ticks in and out.
No,
you're a position taker.
I'm a position taker. I hold things. I entered orders back then, as I do now, with the intention that I'm going to hold on to them. That if I end up day trading the position, it's because I took a loss on day one. Is that I would hold the position. In some cases, I might hold the position for 3, 4, 5 days. In some cases, I might hold a position for 3 weeks. I think there was a position last year that I held for, I think it was $1 Singapore position that I held for 4 months, and that's really the outlier for me. And then what happened is I happened early on to catch a really big move in the Swiss franc and D-Mark. And I really look back at that as not a matter of, I outsmarted the market, but I really truly look back that was almost a form of sovereign providence, that I just happened to have started the business. I just happened to trade the charts. I just happened to catch the market, and I put a big dollar Swiss. Was back at the time it was futures, and I bet a big Swiss franc position on a Wednesday before Thanksgiving Thursday. The markets closed on Friday, and so I put a big position on Thursday on the close, or on Wednesday in the close. Thursday, London ignored the move that had taken place, and so I talked a bank at the time. I was clearing at the time a firm called Gill & Duffa Services, which was a London firm, and I talked their banker into letting me take a DMARC position on Thursday, laying in bed Thanksgiving Day. And the markets were closed on Friday, and by Monday it was a winner. And it was way too big a position. It scares me to think how big a position I put on. I mean, there's
Irresponsibly big.
Irresponsibly big.
Did Mona know about this?
Well, let's see. She knew that I was doing something in bed other than sleeping. I think she knew that I was trading from bed on Thanksgiving morning, and but it frightens me because if that trade would have gone the other way, there's a chance I would have been back in the advertising business within the following month.
But how did you avoid the next trap? So you've gone through the money losing trap. Then there's the next big trap in markets, which is you make money.
Yep.
And you believe that your shit smells of roses.
Yeah.
You kind of think that you can do anything now.
Yeah.
How did you stop that trap, or did you fall into that trap
Well,
as well?
I fell into that trap, but not really. When I look back statistics, I am big into probability theory. I am big into the statistics of my trading. I do lots of work on the statistics of my trading. I know my trading inside and out. I know how the clock ticks. I know when it's not keeping time right. And so, I look back, I've never had a huge give back to the markets. I think the biggest give back I've ever had is 35%. That's peak to valley, including mark to the market positions. There's a lot of people that have suffered far worse than that. And so, that in itself is big. I mean, it's not comfortable losing that kind of money, but I think that's really the influence that my friend Dan Markey, who is a Cargill trader, taught me is you never go home with the losing positions 2 straight days. You never take a loser home on a Friday. And I took a lot of what he said very seriously. And those have really been the principles that I've operated on.
And who taught you about keeping a statistical record of your trades and how you trade and how to analyze them? Was that a standard practice on the pit?
No, not at all. It was very unusual. I mean, keep in mind, when I started trading, we kept charts by hand. I mean, we would buy graph paper at the art store, and that's how we kept our charts. And then about 75, 76, Commodity Research Bureau started printing charts. We'd buy them, and I'd keep those by hand for a month because I was so cheap I didn't want to subscribe to the every week. I'd just buy them at the newsstand at the Board of Trade, and then next month I'd buy and I'd get a fine print. It had to be a black fine print, a fine point pen. And I had a ruler, and that's how we did our charting. And it really wasn't until a few years after that you could actually go on a computer. The idea that you can turn a computer on and you can see quotes, the idea that you can turn a computer on and see charts and call for charts and mark up charts, we wouldn't have believed something like that was even possible back then.
So were you actually in the pit?
I was on the edge.
Signals?
I was on the edge of the pit for a while with Campbell's,
right?
Because they were doing such big volume that it was, we were there. I mean, because they were trading, a couple million corn a day, which is a huge position.
Yeah.
And so, but I've always had pit brokers. I've always had individual brokers, and that includes me as a proprietary trader back in the days of pit trading. If I was trading the New York Stock Exchange Composite Index, which at one point we traded, there was a person that I would call. I would call his assistant. He was in the pit, and he would fill my orders. I had a bond trader who would fill my orders.
So you were generally upstairs for most
Generally upstairs, which was a big benefit, I think, because a lot of the guys who were in the pit never made the transition.
That's right. So talk us through. So we're now in the early 80s. So computers start to come in.
Yeah, commodity quote graphics. 2 things happened in 1982, 83 that really fairly revolutionized the industry. The first was Chicago Board of Trade members could be not in the pit. They could be not in the building to get member rates. This was a big thing. I mean, this was an enormous thing because there was a big difference between paying a quarter a side and going off floor and paying $5-10 a side to trade. The second thing was the invention of the small satellite dish that would receive signals and put them through to a computer, so that you had a rudimentary screen which showed you price. You still had to call your orders in. You still had to pick up a phone. And back then, this was 1982, 83, 84. I was, my telephone bill was $1,000 a month.
Wow.
And, because prior to the satellite dish, you had to get quotes through an AT&T long line, which cost an absolute fortune. And only brokerage firms could afford that. And then they'd go into the clicker boards. Maybe you've seen one of those in a museum, but they were fascinating things. And so, that really allowed me then in 1983 to say, I don't even want to be in Chicago, because there was a rate advantage on commissions there. I wanted to escape the city. And so I moved my whole family to a lake.
So you had a seat, did you?
I did for a while.
Right.
And so I just moved my family up to a rural area of northern Minnesota. We lived on a wonderful lake. It was 15 miles long. We had a house that was, 10 feet from the lake or 15 feet from the lake, and 170-foot sugar sand beach, and,
gorgeous.
A sailboat and a fishing boat. And at first I traded from the house, but then I felt I got a trading office, and so I'd leave each day, some days on a snowmobile, and I traded from up there.
So now you're kind of starting really into your proper career as a trader, trading your own account.
Yeah.
How do you manage your life as a trader where you have no security of income? You have your statistics. You're kind of starting to understand how you trade as a person. How do you manage that unknown element that most people are so used to, which makes going as a full-time trader really hard for most people because they can't manage that whole process?
I got together a year or two ago with a bunch of traders, guys like me, that just trade for their own account. And the topic of conversation is, how do you help your wife understand she can't have a budget? She'd say, can I have a monthly budget? No, you can't. Because it's like, ask me when you want to buy something and I'll tell you if you can or you can't. And it's one of those things. And, to a certain degree, Raul, it's just a leap of faith for an independent, discretionary trader trading his own account, living on his own profits. Your net worth in those early days, my net worth was at risk every single day. I'd open up the office door and my net worth was at stake.
And how do you sleep with that risk? I mean, that's another thing. Many people come into the industry and it is really hard to sleep with risk, particularly when it's your own money on the line. Mm-hmm. Even if it's customer money on the line, if you care about what you do, it's not easy. I mean, it burns a lot of people out.
It is so difficult. And, I think that I have an advantage in that I can look back over my career with the benefit of a lot of time, right? I can look back over really decades of trading, and things now start to take a perspective that they didn't in real time. And I think one of those is my focus was really not on money. It was on what I was doing. It was on process. And my focus was, I want to take trades that a year from now I can look back at the trade and I can say the trade made sense, the entry made sense, my sizing made sense, my trade management made sense, and that's really what's going to count. And if I just keep doing it over and over and over again, at some point in time, I will have the faith in what I do, that I'll have down times and I'll have up times, but in the end of the day, I'm okay. And you have to go through a lot of drawdowns to gain that perspective.
Not only that, you have to truly understand how you trade, because you need to know whether the probabilities that you're assessing are the actual probabilities that the outcomes come out to be. Because if you're saying this trade has a 65% chance of working, 35% chance of failure, you put your stop losses, you kind of know where you are. Now, you can think that, but if your chance of losing is actually losing is 75%, you're going to notice that you're going to keep losing money. You need to somehow make sure that your probability forecast is the same that actually happens, which is, I guess, what you did over time. Your process narrowed it all down.
In a way, in the first place, I don't believe in probability, because probability can only be measured statistically when you have a large number.
Yeah.
And I don't consider what I have, at least right now, 8 trades a month to be a large enough number that I can give a probability to an individual
Let's
trade.
call it a possibility then.
It's a possibility. It's a possibility. But I know going in that there's no average year for me. I've never had a year that'll say, okay, that's just a perfect average year. It had all my benchmarks. It was right on. But over a period of time, I'm right 41% of the time. That means my default expectation is I'm going to be a loser on this trade. When I put a trade on, I expect that trade to be a loser. And I think that's a remarkable mindset to be able to trade from.
Did you learn that? Because most people never learn that. And it's all about where your stop loss is, how much you make on the winners and how much you lose on the losers. And you could 41%, everyone would say, well, you're an idiot, Peter. But consistently you get that right, you consistently make money over time.
I cut losers quickly, and I'm allowed, again, I go back to something Dan Markey said. If I were to say to him, what's your job? What do you do for a living? He'd say, I take losses. My job is to take losses. My job is to take losses quickly. Well, what about your profits? And you go, I don't worry about my profits. I'll let my profits worry about themselves. Up to a point, of course. I mean, you have to have some mechanism which says, okay, this is enough money in a trade, or market is reversed to a certain point that I'm going to change my opinion. But I've come to know the statistics of my trading so well. I mean, I know that I'm going to be wrong 6 out of 10 times. I know that in the course of a year, if I put on 50 trades in my next 50 trades, I know that 8 of those trades will put in my net bottom line. Somewhere between 6 and 10 will put in the net bottom line. And what that means is that 42 of those trades will have to cross themselves out. And so I'm letting 42 trades be a washout so that 8 trades can survive, so that 8 trades can give me my bottom line. I know that during the course of 12 months that I'm probably going to be profitable 3 to 4 months. I mean, profitable in a meaningful sense. And I'm talking there about somewhere between 500 and 1,000 basis points profit. I know that in 4 months, I'm going to be treading water and I'm going to have some good trades and think, man, this month's going to be great. We'll be slapped in the face a few times. And I'm going to have 4 months where I'm going to have to white knuckle it. It'll be to the point where I start to believe, which I believe every year at some point, I'm never going to have a winning trade again. Never again will I ever make money again. And, and that's the way of life. And I keep very careful statistics on that stuff.
I think that's a really key thing, because I've seen a lot of traders in my life and very few truly understand themselves. There's a lot of hedge fund managers, for example, who produce returns, but they don't really understand what those returns mean. They just project statistics. You kind of truly understand, at your darkest hour, you kind of understand this will be my darkest hour, and I know that it's actually going to get better because statistically it normally does over time.
Well, it has so far, but then again, I go back to another saying of my friend, a saying that I really don't look forward to, and that is your worst drawdown is yet to come. And so I always, that's always looming in the back of my mind. And that's the reason that, the old saying is you meet old traders, and that's me. You meet bold traders, but you never meet an old bull trader. And so, I don't want to ever be too bold. My bold days are over.
And so when you started having success, you started to build some real capital, when you weren't putting all of your net worth on the line. So I guess we're probably into the 90s now.
Yeah, we're probably in the 90s at that point.
Do you start saving money putting it outside of the financial markets, or are you always putting your savings on the line?
No, I'm not always putting my savings in the line, but I'm always liquid. I'm always liquid. And so I don't tie up money. I have way too much money that sits in cash because I know that, if I wanted it to be available for a trade, it's there. And so for me, it's actually even hard to, produce what a rate of return is, because just a small amount of money is held in brokerage firms, especially futures firms, because there's a bad history of futures firms going broke. Yeah. And I've been involved in those. I lost
Me too.
money.
MF Global, I lost money in.
Yeah, MF Global, I lost a considerable sum with Revco when they went out of business. At the time, they were the largest futures commission merchant. I lost money with Peregrine Financial. financial. And so I'm very aware of
That's an
counterparty
interesting thing,
risk.
because that's another risk that people don't realize. They don't think of counterparty risk. So they're busy trading away. They think they've got their shit sorted out, and before you know it, the counterparty's gone bust. Somebody's run off with your money.
Exactly right. Exactly right.
And how do you deal with that? Do you use multiple clearers?
I use multiple clearers, and I keep a minimum amount. And so usually I will keep a maximum of 20% of the money that I have kind of designated in my own mind as the AUM. This is my AUM that I'm trading right now. And I kind of set that level a couple times a year where I think this is the sizing that I'm going to trade to. And for me, that's generally will represent a certain size position. Like per $1 million, it'll usually represent somewhere between 6 and 12 futures contracts per $1 million is the sizing that I think of in my head. That's the appropriate sizing. Or in the case of a Forex position, it would be, depending on what the primary pair it would be, somewhere between 300,000 pounds something per million to New Zealand something. And so I have that, but I only keep a small portion of that, what I need at the futures commission merchant or at the Forex dealer. And if necessary, I can move money back and forth on a pretty quick basis.
In terms of margin you put down versus the trade size, are you generally very leveraged in that? And I understand you've got cash balances.
I am with the money that's in the account, but I'm not against the money that I consider to be my AUM that I'm trading.
Right, yes.
Against the AUM that I'm trading, I am generally probably somewhere between 10 and 20% margin to equity. And I'm only trading leverage markets. I mean, for me, it is, I've come to the point where it's inconceivable to me why not everybody trades leverage markets. I mean, leverage markets are actually much more easy to control risk in a leverage market than in a non-leverage market, in my mind.
What? How? Why?
Just because you have 24-hour markets, you've got the liquidity, you've got much more liquidity in, let's say, Euro US than you do in, an awful lot of stocks. You look at December 1920 Euro-dollar futures in the middle of the night, and it's 10,000 bid, 20,000 offered. I mean, it's crazy the liquidity that you can find in certain markets. And so I just find that cash management, because I don't have to have 100% of my AUM wrapped up in the purchase of a stock at cash value, and of course you could reduce that by trading on margin, of course. But because of that, I have a tremendous amount of flexibility in terms of cash management.
Yeah.
Yeah, and so I like that. I like that flexibility, that I know that I'm only trading against 10 to 15, maybe 20% of the outside of the money that I have allocated for leverage transactions.
So we're now going back to the story as we go through. We're now in the 90s. How things changed in the 90s? Now the Chicago pits are huge. Stuff like the Euro-dollar pit is the largest pit in the world, I guess.
Yeah, I mean, it was an acre. But here is where my life took an interesting turn, because I got burned out about 95. And I took 10 years off from the markets, and I walked away from the markets. I closed up. I didn't have a quote machine. I put money into stock mutual funds and didn't trade futures for a decade.
You put money in stock mutual funds?
Yeah, isn't that crazy? And I became a passive investor and got involved in other stuff. It was a good time to be a passive investor.
Well, for a period of that, it was a good time to be a passive investor.
Yeah, not bad. Yeah, I mean, there have been worse times.
95 to 2000 was pretty good.
Yeah, 2000 to 2003 wasn't real fun.
Not so good, no.
Yeah. But so, I took a period of time off from the markets because I was just, I was burnt out.
Yeah.
And I was burnt out because we had gotten to 24-hour markets. We're living up on the lake, and I'm getting calls. I would go to bed at night, and I would call the dealer, which at the time was the Commodity Corp dealer, and I'd say, okay, I'm in Mark, here's my band. Call me if the market hits my band. And so I'd go to sleep, but invariably you're trading 5, 6, 7 markets, something's going to hit a band. And so you get calls at 2 o'clock in the morning that, oh, by the way, your dollar Swiss has hit your band. What are you going to do? And so, you're
not sleeping.
You're not sleeping. You're awake the whole time. And I just got so burnt out. I just said, I can't do this anymore. And so left and went off and did some non-profit charitable stuff for 10 years. And I remember the conversation. I think it was 2006. I was sitting in my desk at home. We had moved to Colorado. We moved to Colorado during this period from Minnesota. And I'm sitting at my desk. My wife is standing to my left, and I say, "What do you think about us doing commodity trading today?" And she's kind of going, "Well, I don't know." But anyway, started it back up, started the account. And this was really, really interesting, Raul, because there had been 2 massive transformations during the period in which I was no longer involved.
Yeah, everything's changed.
Yeah, we were in electronic markets. Now, we still at the pit market, and so I had the option. I could call it down to the pit and have it pit filled, or I could enter it onto Globex. The second thing was you're trading off a computer. And then the second thing we had high frequency trading operations. We had the algo guys in town, and so I had to relearn the business to some degree, because I was used to calling up and placing my orders. Now it was a matter of entering orders, at least to the degree that I did, on a computer. It was to trade off of a screen. I was not quite used to that way of trading. The second thing that was happening was I was pretty set on the way I trade, and so I have to ask myself the question, I wonder if how I traded before will still work. Will it still work? Will the charts work? Do the patterns still work? Can I still trade head and shoulders? What's different? What's not different? And there were some things that were different. There were definitely some things that were different. But I came back in 2006 and had an 80% year.
So you didn't even have to pay an education for
I swung 100% plus the next year. And I found out very quickly that, hey, what I've done does still work. And, and that was a good education for me, is that even though we've had these change in markets, even though we've had high frequency trading operations, there were things that were changed. And there are some ways that I tactically trade today that I think I need to do to adjust for HFTs and algos and 24-hour markets. I mean, there are a number of things that I do differently today that I wouldn't have done back in the 90s or the 80s especially, that I do now. And that I didn't even really need to do back in 2007, 2008, 2009, 2010. But I think starting 2011, I started seeing a more real change in market behavior.
Yeah, I mean, it's interesting because charts are basically show you how humans think. It's just human psychology. And that doesn't really change. So that works over a whole period of time, because you and I can look at a chart going back 300 years.
Yep.
And you can see chart patterns 300 years ago that worked.
They do.
But as you say, the markets have changed because human psychology is now not the main player in the markets anymore.
Well, no, I mean, not to the degree they were. I mean, the patterns still work. Here's kind of the irony. If somebody said to me, I believe all really good traders have an edge somewhere. And if they can't define their edge, chances are they don't have an edge. I mean, what's your niche? If you can't define your niche, you don't have a niche. What are you doing that is giving you the benefit to be able to take money out of the market each year? What things do you do to do that? And even though I'm a chartist, I don't attribute my edge to the charts. I mean, as a matter of fact, I'm really not sure that charts offer traders an edge. I mean, they offer a small edge, but an edge that's really insignificant relative to the kind of performance that I want during the course of the year. A chart in its nature shows where a market has been, and it shows the path of least resistance for a market. In my opinion, a fundamentalist might say to me, Peter, I don't believe in what you do because I don't believe charts work. My first response is, I completely agree with you. I think they make money in charts.
Have you tried randomly trading,
no
charts, and seeing if your risk management is actually the edge that you have?
Well, I think there's two. I get my edge from two things. First is risk management. It's very aggressive and very active risk management. The second one is size differentials, that there are trades that I will put on, that I might put on a trade at 30 or 40 basis points risk. Meaning that I put a trade on and I'm willing to risk 0.3% of my AUM on a trade. There are other trades that I'll put on that I may risk up to 150 basis points. There are periods of time when I downsize my risk.
So this kind of amount of risk is very low compared to, let's say, the George Soroses and some of those guys who are the big risk takers. There's very few, as you say, big risk takers that last forever. There's some who can.
Yep, but it's really unique because they trade very infrequently. They trade very special opportunities.
Yes.
They layer into trades, they layer out of trades. And so even though they have a large, let's say, nominal value of their trade, they don't have necessarily a total risk that's comparable to the nominal value of the trade by the nature of how they get into a trade and how they get out of a trade. But they trade very few times. You think of Soros' play against the pound in the Bank of England. So I'm trading, 50 to 100 times a year. These guys are not making 50 to 100 trades a year. They're making really very, very few, very selective trades. And so they may be risking 5, 10, 15, sometimes probably 15 as the outside max of what they would consider to be their capitalization on an individual trade. But for a trader who is an active trader, and you can't do it that way.
No.
You mentioned the Richies. The Richies are very much into probability theory. They're very much into the statistics of the game. And I know Mark Jr. and I have worked on some very sophisticated Excel programs which take a very interesting and thorough look at risk. And we know from the numbers that if a person who is an active trader risks 5% of their capital on the trade, they're going to be history. They're going to be carried out. They're going to be carried out on a cot. It just can't happen. It's inconsistent that at a 5% of asset risk level, your win rate has to be an unreasonable number in order for you to survive.
So this is something that people don't understand. These pure stats of, if your trade size is too risky and you have, let's say, 50-50, which would be a great rate of winners versus losers, your losers will take you out and lose all your capital too quickly.
Oh, absolutely. Absolutely.
And most people don't realize that.
Well, they don't. And they may say, well, I'm only taking 100 basis points or 1% risk. But then when you start exploring it, you find out they became obsessed about the market and they took that same 100 basis point risk 10 times because they wouldn't leave the market alone. They became fixated on a certain market. They absolutely had to own gold. And so, over a course of time, they lost 10 to 15% of their capital on gold, but in their mind, they were only taking 100 basis point risk.
And if you're looking for a risk reward, let's say you're risking 30 basis points, what are you looking to make, 3 to 5 times?
No, I don't look at it that way. I think I did at a time, a long time ago. I kind of had those numbers, but I don't look at it that way. I'll take a trade sometimes that I think really has a reverse risk. I'll risk 70 basis points if I think I can take a 35 basis points profits out of the market in 2 or 3 days. So I'm not as conscious about that anymore as I am just simply that I know where I'm wrong in a market and I know what my downsize is.
So what happens when you get stopped out of a trade, market reverses, that old famous chestnut?
2 times and that's it.
I'll have 2 shots at it.
Yeah, I'll date a girl twice, and from there on, it's somebody else's date, right? So, and that's true. And I've missed some moves. I tried to play dollar yen last year, and I tried it twice, and I was wrong. If I would have tried it a third time, it would have been a charm. But I have to be rules-based. I have to be disciplined.
So why haven't you created a algorithm?
Well, I'm not sure one can really create because I'm so discretionary. I've seen people try to create algorithms for pattern identification. And everything I've seen has left me somewhat empty. And I think that for me as a discretionary trader, the fun part is in the nuanced interpretation of the chart. I'm very selective on chart patterns and what chart patterns I take. I'm extremely selective. I see a lot of charts that are posted on Twitter, and I kind of go, boy, that's a map on getting to some distant star system. But that one's not in my galaxy, much less in my solar system, right? And so I'm very, very selective.
Well, what is interesting, as you alluded to earlier, is different traders have different things to work for them. They could be the complete opposite of you, and they can still make money.
Absolutely.
And it's really just understanding what works for you, your psychology, what gives you the tools to stomach the risks you have to take, and all of those kind of things.
Yep.
So let's move forward now. So we're now into of 2010. What are you doing at this point?
Just trading. Yeah, I'm just trading. That's when Wiley had been after me to write a book. And I finally consented and said, okay, I'll write a book for you. And the name of the book was going to be 12 Months in the Life of a Commodity Trader. And I had 5 months written, and I wasn't smart enough to back up my computer, and I got hit by lightning in Colorado. And the whole thing's gone. Right?
Even risk managers miss some risks.
My risk management wasn't real good on that one. And so it's gone, and my computer's fried. And so my wife's father has a townhouse on just south of Santa Barbara in California, and I asked him if I can use his townhouse so I could really get on this book and get caught up. And I go out there, and I'm really going to dig in, and I'm going to get this thing written. And I've had some neurological problems in my life from an accident that I had in 1984. And my neurological problems kicked up in California. I go into Mayo Clinic in Minnesota. I'm there. And the name of my book ended up being 5 months in the life of a commodity trader. And I had tried to talk Wiley into resetting the clock, and they said, no way. And we've got the printers lined up. We've got the promotion schedule. We have all of this lined up. And of course, they plugged me into Twitter. And I just figured, that book was a surprise in my life, because I figured, who's going to buy this nerdy book of mine showing charts? And it ended up being the #1 book on Amazon Finance for 25 straight weeks, which just absolutely amazed me. Who are these people that are buying this book? But, apparently they did, and Wiley's been after me ever since to write a sequel.
Because everybody's desperate for knowledge. There's very little knowledge that comes out of the trading industry. There are bits of knowledge you get, and everybody's desperate. One of the things about RealVision is people are there gleaning information, because there's so few ways that you can learn. Because a lot of learning, is the experience of doing it, but you need the mentor.
Oh, I'm amazed.
And you had the mentor, so the book for other people is like, I've got my own mentor now.
Yeah, but it shouldn't be. And that's what I tell people, is my own book is not in my recommended 10 best reads. I mean, it's just not. Because the nature of my book and how I had to write it didn't become the book that I had envisioned going in. Because I don't believe you can read somebody else's approach to selecting trades and have it be successful for you. I just do not think that every trader I know, and over the years I've happened to meet a lot of really good traders, a lot of them from my time with Commodity Corp back in the 80s and early 90s, and that, of course, was kind of the birthing place of some fabulous traders. And so I've met a lot of good traders.
A lot of people came out of Commodity Corp.
They sure did. I mean, you had Ed Sakota, Paul Tudor Jones, Bruce Kovner, Marcus. I mean, they were just fabulous traders that came out of that experiment. And then, Goldman Sachs bought him in the late 90s and moved it to London and ruined the firm.
Obviously.
Yeah, exactly. But, not two of them trade the same way. And you try to explain that to people, is you've got to find your own way, and it takes time, and you're going to make mistakes, and you're going to stumble through the process. And I think a lot of novice traders are looking for the magic bullet. They're looking for what to buy now and how to buy it, and they look to copy people. And I think that's the real advantage. I'm in awe when I go on RealVision TV, because I listen to these people, and you have to keep in mind, I don't know anything about really the markets I trade. I know a little bit about the grain market fundamentals. I know they plant it in the spring and they harvest it in the fall. And, I know a little bit more about that. I mean,
it's only because you live near the wheat fields.
Yeah, exactly. So I know the grain markets a little deeper than I know other markets, but I really don't care. I don't care the name that's on the upper left-hand side of a chart. I care about the price scale that runs down the right side. That's what I'm trading. Somebody may think they're an investor Well, Warren Buffett's an investor because he buys the whole company and his purpose is to live on the income flow of that company over a long period of time. Somebody that buys a stock and sells it within the next 20 years is not an investor, he's a trader. And traders trade price. They may think they're trading the name of the company, but they're not. They're trading price.
Yeah, price and time.
Price and time. And the sooner they become accustomed to the fact that they're time and price traders, the more that they start to have a realistic expectation of what they're doing in their life. And so I make no attempt to understand a company or an economy. I don't know when central banks do things. I don't know when the Fed does things, and I don't want to know. And that's, for me, it's very entertaining to go on RealVision because I listen to these brilliant people. And I do purposely, not necessarily to learn from them, but to try to get a sense for how they think. That for me is what the key is how do different minds work?
And also, it's a learning process just because that's not what you do. But there's a whole world of interesting stuff out there. That's why I love RealVision as well.
Oh, it is.
It's a world of interesting stuff. And,
Yeah, I listen to these people and go, how do these people know all of this stuff? I mean, really? Because I make my decisions by looking at a bunch of bars on charts, and their depth of knowledge is so much more. Where I think the world I live in is the world that you live in from the point you enter a trade. Where they live in, obviously you do some analysis to determine what you're going to enter a trade in and when and so forth. But the front end, the big front end of understanding global macro things, understanding a company, understanding its management, understanding the world that company lives in, that's a world I know nothing about. And I like it that way. But I know a lot of people live in that world, and a lot of people who are my friends live in that world.
I must admit is most of the most successful macro traders of all time are all chartists. Mm-hmm. They filter every idea from a chart first, whether it's Paul Tudor Jones, whether it's Stan Druckenmiller, whether it's Lewis Bacon, all of these guys, chart first. Look at that chart. That's an interesting chart. Let me find out some more so I can give myself a better edge. That's basically...
Yep.
And how does that fit in my framework of life?
Yeah.
So therefore, do I think it's going to work with my framework, in which case I can take risk in that? If it's the opposite, maybe it's some information I should use to change my framework. But charts are everything.
Yeah, and it's an interesting point. Another thing that my friend Dan Markey told me at the Board of Trade, which was fascinating, and I haven't heard a lot of people express the same sentiment, is he believed in a concept which he called the dominant factor theory. And he believed that for any given market or combination of markets or composites of marketplaces, there is one driver that may last, well, in the case of grains, it may only last a year, but in the case of underlying economies, it may last 5 years, 10 years, or more. And that every other fundamental factor just adds noise and confusion. But it is that driver that is going to make a market go from point A to point B over a period of time. And all the little jiggles and jaggles that take place in between are not coming from that dominant factor, fundamental factor, but they're coming from other things. But the challenge, of course, is knowing exactly what that dominant factor theory is because a lot of people will build this big... the thing that always amazes me is I may make a statement on Twitter about the U.S. dollar, and somebody will chime in and say, what does that mean for gold? And I'll go, all I know is I can't enter a U.S. dollar order in the gold pit.
Everybody is hilarious. Anything you put on Twitter, the general response is, what does it mean for gold?
Exactly.
I don't know why gold, but I think gold people are...
It's amazing. Or people with a chart book, they'll build a whole global macro narrative based on one chart. I've never figured that out.
Well, you can if it's the dominant factor.
You can if you know it's the dominant factor.
Yeah, I truly believe in that. I mean, I've made my career doing that. That's really what I try and do, is distill everything down to the simplest thing. Can I explain it to that guy over there in 3 minutes why I love Iran?
And you do that with GMI. I mean, you do it wonderfully well with GMI. But in a sense, so if somebody says you would just absolutely ignore the fundamentals, my answer is, really, I don't. But really what I try to do is from a chart, if I see a 6-month pattern that for me is just a drooling, wonderful pattern, it tells me that I think I know which way the dominant fundamental factor is going to drive this market. I don't have to know what the dominant fundamental factor is.
But you know what it's doing to the market.
I know what it's doing.
Exactly right.
Yeah, I know what it's doing. And so that for me is key, that I absolutely believe that a fundamental is going to move any given market over a period of time. I don't have to know what that is.
So did you ever run outside money?
I did for a very brief period of time. Of course, that was Commodities Corp money, but I considered that to be prop money.
It's just essentially extra capital for you to trade.
It was extra capital. I viewed it this way: as I do 100 contracts, and it gave me a free call option on 15 contracts because you're doing a 15% profit deal, right? And so I could trade 100 contracts of somebody else, of another prop firm's capital, and I'm taking the profits on 15 contracts without any downside risk, and that was a good deal. But I decided way back when I have not really run any outside money for more than 20 years.
So you've lived, breathed, eaten just on your own trading.
On my own trading. And I don't want to trade other people's capital. I really don't. I think trading other people's capital would basically ruin me. It would screw up my head so bad that it would affect my own trading. And so why do that?
So a cynical person would look at you from the outside and said, so why do you write about it? Why do you have Factor? The research?
Yeah.
Because they say, well, if he's so good, why does he need to have a research service? That's the cynical answer you would get.
Well, because I don't want to do a research service. I started doing in 2014 is when we introduced this a weekly report that I would write that really reflects what I'm doing in my own proprietary account. I'm not doing research on technical or chart research on a whole wide range of markets. I'm doing it on the markets that are of interest to me. What markets do I have positions in? What markets am I looking to have a position in? Or what markets are particularly interesting to me? Or is there some textbook examples of things going on that there'll be in an Edwards McGee book 100 years from now that I can point out now? But really, I went into this with the idea that trade identification, which is what most people pump, most people are trying to sell trade identification or what I would call a signaling system. You don't do that with GMI. You educate people and you happen to have your own portfolio. But an awful lot of people that operate on the technical or the chart side of the world are selling signaling systems. And I don't think selling signaling systems is really a way to educate people. So really, what I really want to emphasize to people is four things. I do want to emphasize charting, and I want to emphasize charting because I've seen charting drift. And not that I'm opposed to different approaches to charting. I'm all in favor of charting a certain way makes somebody money. Let them go for it. All the more power to them. But I wanted to represent charting as it might be seen in today's markets through the eyes of Richard W. Schabacher, who wrote really the original book, the book that Edwards and McGee came out of. Schabacher wrote his manuscript in 1933 and really was the founder of the classical school of charting. The pure heads and shoulders, triangles, and so forth came from Schabacher. And I wanted to give really devotion to the way he would view a chart in very simple terms. Second thing I wanted to do is talk about risk management, because that to me is where risk management pays the bills. But you're doing this not for your own income. You're just doing it to educate people. I want to educate people. Yeah, I mean, there's a revenue flow, and the staff. I'm a minority shareholder, really, in the company that produces the service. A big minority shareholder. And because I produce the content, because I've always journaled about the markets, and it actually was a staff member who came to me and said, "You're writing this stuff everywhere. Anyway, can we take it and market it?" And I felt, go for it. As long as you don't embarrass me or put me in jail, I'm all in favor of it, so go to it. So, I really wanted to hit home on risk management because there's so much lip service given to risk management. What does active risk management and trade management really look like? The third thing was the mental side of the market, because I happen to believe, and I know that you do too, Raul, that especially discretionary traders, not so much systematic traders, but a discretionary trader is his own or her own worst enemy. You want to know, as a discretionary trader, a trader, who your worst enemy is, just go into the bathroom and look in the mirror, and you're going to see him firsthand. Warts and all, you're going to find out. And if an individual wants to know themselves, who they really are, every character defect they have, go and trade for 5 years. You're going to find out. If you got a problem with greed, the market's going to teach you. If you have a problem with false hope, the market's going to teach you. If you have the problem with indecisiveness, the market's going to teach you. If you are open to learn about yourself, the market is a great teacher. And so, Richard Dennis was the one that said, successful trading is an upstream swim against human nature. And it's so true. Then the fourth thing was really the process of market speculation. For me, that is a big one. I'm not sure what date, let's say, what are we, January 10th today?
Yeah.
I'm not sure what day January 10th is in 2019. But if it is a Monday, Tuesday, Wednesday, or Thursday, I know what I will be doing at this precise time on that date. Because my life is run like a clock. I look at certain charts, certain time, each week on certain days.
But you're going to give up at 2020. That's
Yeah.
it. You've set yourself the date now.
I have.
So then 2020, between now and 2020, it sounds like you want to, and very luckily for us, give back some of what you've learned, because you've done an incredible amount of self-analysis. You've learned a lot of things on the way. And then you get to 2020, you turn off the computer,
Yeah.
put those charts aside,
No, I'll still trade, but my public voice is gone.
but you're still going to trade.
Yeah, but I already know how I'm going to trade. I can throw daily charts away.
Right.
I'll look at charts on the Sunday and inner orders and downsize, cut my size in half and try to trade 20 times a year. That's kind of in the back of my mind
So
right
that's
now.
more, I know it's not true investing for the discussion we had before, but that's a more of an investment style to let these things work over a longer period of time, less
Yep.
volatility,
Yep.
less waking up in the middle of the night thinking I need to put a stop loss in.
Yeah, because I love markets, so it's tough for me to ever see the day that I don't know what the markets are doing. But it takes, as you get involved in Twitter, you get involved in GMI, it'll eat your lunch. You're all in. And if you're not all in, you're really not doing the job that you're supposed to be doing if you're not all in.
Yeah, and as soon as you stop focusing is when you get into trouble.
Oh, big time. Yeah, it's big time. I always tell the people that, if you don't use a stop, it's the marks that you don't use a stop are the ones that are going to, worst trade I ever had was an $8 full loss in the crude oil market. And, that's the kind of thing that'll happen to you if you're really not alert on a trade.
Yeah.
Little trades, I've seen that happen to people as they let a little loss, all of a sudden, I'll get out of it when it's break even, and then pretty soon I'll get out of it if it hurts a little bit less. And eventually, of course, they're going to end up getting out of it. They're going to end up getting out of it. And when they get out of it, please let me know, because that will be when the market turns.
It is like that. That's what markets do.
Oh, I've seen that so many times. And so, that's what I want to do is, I've had to pay dues as a trader the hard way by taking a lot of hits on the head, by a lot of bruises, a lot of cuts. And, I just, to those people who want to maybe learn some lessons without necessarily taking
as many hits,
I'm willing to kind of share some of those things, especially on the risk management and process side.
And that's, fantastically for us at RealVision. We're going to do a whole series on you because, it's so lucky for us to have someone like you who's accumulated so much information, who will then talk about it and teach the younger generation, people who want to go into that great career. I think it's one of the most beautiful careers is the investment business, particularly the speculative business, because even if you use charts, whatever it is, it's the world's most beautiful puzzle. And you're always working on it and trying to perfect it, and it's a great thing. And for you to give people some of the tools to help them learn to solve this puzzle for themselves, and you never do solve it, but you get as close as you can.
Yeah. No, you never solve it. No, you never solve it. And one of the questions you asked before we started taping is, what drives me today? And it's not money. I mean, it's not the profit motive, although certainly I'm not looking, I was a pilot. I know the cost of owning airplanes and flying airplanes. I don't want trading to be, a hobby that I have to pay to do, right? But it's the pursuit of excellence. I mean, it's the pursuit of excellence that drives me now. It's trying to find a trade where I'd be able to say I wouldn't do anything different on that trade. From start to finish, that's the trade I wanted. And, those are the things that drive me now. But it's a fascinating business. And I've had this conversation with other, proprietary independent traders. You pinch yourself. Really? I've been able to do this to support my family, to support my way of life, to pay my bills since my mid-20s, and I will be 70 years old in this year, and I've been able to support myself this whole period by being a market speculator? Really?
And for about 10 of those years, you only worked about 4 hours a day.
That's, well, I try, some days I
because
only
the pits
work
would
4 hours
open
now,
at what? 10
but no, pits in the Board of Trade, 9:30, 1:15. That's why I hate having currency positions back then, because you had to be up at 8. I had to be downtown at 8, and you do your out trades, you'd have to be down there at 7. And they stayed open till 2. What awful markets. Whose idea was it this, to have a market be open 7 hours a day? What crazy person would decide that?
24
right?
hours and it doesn't stop. Peter, thank you so much for coming to talk to us, and I look forward so much to hearing the series of you and your thought processes and how you approach things. I think RealVision viewers are blessed to have this. And thank you so much for hearing your fascinating story.
Oh, it's my pleasure. Thank you, Raul.